Hello, today's January 11th and it's around 11 a.m. No doubt the recent volatility triggered by the devaluation of the Chinese currency has all market participants concerned. There's no denying the interconnection of the world markets and the spillover effects that international events have on our markets. If you listen to the financial media, there's no shortage of a growing chorus of doomsayers. However, on a worldwide basis, we still appear to be in the strongest economic condition relative to other foreign economies. Investment dollars are still flowing here. Unemployment is low and improving. GDP growth is also low and improving. Corporate revenues and earnings are slowly improving. We're deeply oversold according to many technical indicators. I'm not of the opinion that we are due for an imminent crash. Crashes are typically caused by overvaluations. And although the major averages did establish higher highs not long ago, we don't appear to be terribly overvalued at this time by many measures. In addition, John Templeton said it best when he described that bull markets die on euphoria. I just don't see euphoria in the market right now. Current market action feels more to me like a correction than an imminent market crash. Corrections occur fast and furious. Recoveries are typically slow and methodical. Could the correction go further? The answer is yes. The Dow peak value was around 18,000. The Dow is currently trading at 16,350. The next major support level is 16,000, followed by an August low of 15,400. Right now, I anticipate continued volatility. The major averages are currently down about 10% from peak value. By recent standards, this is proceeding like a normal correction. If it develops into something more, we will be taking action. However, over the past 8 years, these type of corrections reached an equilibrium point once the bad news dissipated and the institutions began bargain hunting, thus delivering us a slow recovery. Over the weekend, we went to see the movie The Big Short, which describes the real estate bust of 2007 and 2008. I personally found the movie very interesting and I did enjoy it. Of course, Anne almost fell asleep, but if you don't like everything financial, you might fall asleep too. Nonetheless, with so many people watching this movie and trying to relate it to current events, I can't help but think the average investor may be suffering from a bad case of recency bias. In its simplest form, recency bias uses our recent experiences as the baseline for what will happen in the future. In many situations, this bias works just fine, but when it comes to investing in money, it can cause problems. Everyone that's seen the Big Short movie is likely worried that the next big market collapse is just around the corner due to recency bias. Events that occurred in 2007 and 2008 are brought back to today. It's very difficult to separate today's fundamentals from the Hollywood sensationalism designed to sell movie tickets. Let me just suggest that we continue to do our homework very diligently and that the circumstances of 2007 and 2008 are very different from the circumstances today. As always, should you have any questions regarding anything financial, please don't hesitate to call us. We're here to help, and thank you for listening.